Hello, global investor, and welcome back. Zillow, a popular real estate website that sells and rents properties online, has decided to shut down its iBuying unit. This decision could be a sign of the housing market cooling off after years of exponential growth. In 2007, Zillow was founded by two former Microsoft employees who wanted to make it easier for people to find homes they want in their budget. The company has grown exponentially since then and is now worth over $2 billion. However, with a shutdown of its iBuying unit, which helped buyers purchase homes through Zillow directly, many are wondering if this signals a downturn in the housing market. Welcome to GOALBULL, the place where future successful investors gather and get inspired. If you have not subscribed yet, you're missing out. Alright, let us dive in. According to Cathie, Zillow's decision to shut the iBuying unit might be a warning signal for the housing market. Closely followed innovation investor Cathie is interpreting the shuttering of Zillow's home flipping business as a cautionary signal on the overall housing market. You'll notice that Zillow shut down its iBuying, so that could be a bit of a warning on housing, Wood said during an ARK Invest webinar. There is so much speculation because of private equity funds just plowing money into real estate, and the iBuying race to buy homes and then renovate them and flip them, Wood added. That came to a bit of a screeching halt, at least the iBuying. Last week, real estate company Zillow announced it is closing its home buying unit called Offers. Zillow ultimately found it too difficult to predict the home prices, which have been volatile due to the pandemic. Analysts wondered why they had trouble predicting prices in such a booming housing market and were surprised that the company chose to outright shut the unit. Wood herself has been dumping the stock. ARK sold about 2.86 million shares of Zillow following the announcement. Shares of Zillow are now down more than 36% this month alone. Wood said ARK Invest is paying close attention to Ivy Zelman's call on the housing market. Zelman, known for calling the top of the housing market before the financial crisis and a widely followed analyst on the sector, told CNBC last month that the market is already starting to moderate amid a rise in bond yields. While Goldman Sachs sees home prices rising another 16% in 2022, Zelman, CEO of Zelman & Associates, takes the contrarian view that there is overbuilding in the single and multifamily home sector, clouded by dual ownership and institutional capital. Zillow's stock price has plummeted by 2/3 since February as the company's new home buying operation turned into a money-losing anchor. Zillow shares plummeted 25% after the company announced plans to exit the home flipping business because of an inability to accurately predict housing prices. Once a pandemic winner, due to its central position in the red-hot housing market, Zillow has lost 2/3 of its value since February and is trading at its lowest in 16 months. The stock dropped $21.63 to close at $65.57. While its core internet marketplace continues to grow and produce cash, Zillow reported a third-quarter net loss of over $328 million, all tied to its instant buying or iBuying unit. Zillow announced that it is exiting the Offers business after its homes unit posted a pre-tax loss of $422 million in the third quarter. Offers were deemed too risky, too volatile for our earnings and operations by CEO Rich Barton, who added that it had a lack of a return on equity potential. CEO Rich Barton told analysts on the earnings call that Zillow was shuttering its iBuying operations, where it competes with Opendoor in a move that will result in cutting 25% of its workforce. Zillow entered the business in late 2019 with hopes of using its popular marketplace site and massive data sets to profit from buying and selling homes in high volumes. We determined that further scaling up Zillow Offers is too risky, too volatile to our earnings and operations, too low of a return on equity opportunity, and too narrow in its ability to serve our customers, Barton said. We've been able to accurately forecast future home prices at different times in both directions by much more than we modeled as possible. In particular, the pandemic threw Zillow's predictive abilities into disarray. The housing market dried up for a brief time early last year, and then skyrocketed as the closing of offices and slowdown in business activity in cities led people to move to locations they deemed more desirable. Prices ran up, setting records in many markets around the country. Zillow was able to make money selling homes at high prices relative to where it purchased them, but at the same time, the company was ramping up its buying. The iBuying process allows homeowners to sell on Zillow instantly for cash, rather than going through a broker and dealing with an extended bidding and closing process. After purchasing a home, Zillow would invest in repairs and maintenance, and even when factoring in all those costs, try to sell at a profit. When the labor market tightened and supply chain bottlenecks sent costs for supplies soaring, Zillow's already thin margins melted away. And to that, a housing market that flattened out or stopped increasing at the rate Zillow expected, and the company found itself drowning in a pool of underwater assets. Barton said the company has learned that it can't sufficiently trust its pricing model, so it's best to exit before jeopardizing the whole enterprise. What it boils down to is our inability to have confidence in pricing in the future, enough confidence to put our own capital at risk, he said on the call. In our report with the headline, "Can't Justify Buy Without iBuyer," BTIG cut its rating to neutral. Piper Sandler made the same cut to its recommendation in its report Z offers mothballed as the company heads back to its roots as an asset-light model. Stifel Nicolaus and KeyBank opted for the same play on words in maintaining the equivalent of hold ratings on Zillow shares. Stifel headlined its note, "From flipping to flopping," while KeyBank went with "Flipping is a flop." Zillow is forecasting another loss in the fourth quarter as it recognizes between $240 million and $265 million in write-downs tied to inventory it's already agreed to purchase, and up to $230 million in impairment and restructuring costs extending into next year as it winds down the offers business. Zillow's abrupt exit from the home buying market is leading investors to see an opening for Opendoor. A day after Zillow's stock fell to a 16-month low, Opendoor shares soared. Opendoor is a San Francisco-based company which went public late last year through a special-purpose acquisition company, pioneered the instant buying or iBuying market, allowing homeowners to sell their property online for cash, rather than going through extended bidding, sales, and closing process. Hey GOALBULL investor, what do you think about the housing market heading to? Any thought on the competition between Zillow and Opendoor in the instant buying house market? Comment below and let us know your thoughts. We hope you enjoyed this video and found it useful. We want the very best for you in your investment endeavors, so don't forget to subscribe if you haven't already for more high-quality content updated 4 times a week.